Hello, finance students. This week we're going to expand NPV a little bit and think about scenario analysis and sensitivity analysis and break-even analysis. So what these topics are is a way to maybe add in a little bit of humility into our NPV capital budgeting consideration. And the reason we need some is the following. So when we made our project pro forma income statements, we were typically forecasting several years of future earnings of our project, and these were educated estimates of the amount of sales and the variable cost and the fixed costs associated with the project. So there has to be some kind of recognition of the fact that these numbers, while not pulled out of thin air, are definitely only based on our logical assumptions about reality that at least should have at least some amount of not necessarily skepticism, but recognition of future likely variability. All right, so I may have a forecast of what the pro forma income statements look like in the future, but I understand that the true actual earnings of the project will be something other than what I predicted, potentially higher, potentially lower. Scenario and sensitivity analysis are a way to directly estimate variability of the project outcomes, either by exploring specific possible scenarios or by exploring the sensitivity of the outcome to certain inputs. So, for example, we might reasonably assume that a variable cost of 40% might actually be 45 or 35, depending on commodity prices or technological innovation or competition or all sorts of factors. And so a reasonable thing to do would be to say, well, how sensitive is our final NPV result to changes in variable costs? Or what if we have a high variable cost scenario? Is it still going to make sense to do the project even in a high variable cost scenario? Right? If it turns out that doing the project is a good idea across a wide variety of scenarios, both positive and negative, that would be strongly indicative of this being a good project. So not only do we have positive NPV, in the case we are confident that our NPV will stay positive even if things turn out not quite exactly how we thought. So what this means generally is that we'll have our spreadsheet model of the NPV analysis, and then we'll tweak some of the inputs and look at the outcome of doing so on the NPV itself. And for this to put this into practice, we're going to use an example. So the problem we'll be working through consistently in the lecture today is it's a imaginary company, Stewart Pharmaceuticals, that has created an imaginary drug that is effective against cold. So we have we would imagine a high demand product that we could potentially offer to the public. But it's not a guaranteed success yet, partly because we're not sure if the drug will pass final clinical trials. So to do that, we have to spend $1 billion. And if we spend $1 billion, we estimate that there's a 60% chance that the test will be successful. Then if it turns out that it is a success, then we can spend $1.6 billion more to put the drug into production and then sell it over 4 years before presumably a competitor comes up with this competing product, or it goes on generic or some other kind of outcome. So first, we should figure out what is the NPV of this project assuming it's successful. So there's a couple assumptions we're going to make. They're not listed in the slide here, but you'll see they show up in the numbers on the next slide. So our assumption is that we will sell 700 million doses at $10 each if it turns out that we can sell doses. So obviously, if we have a worthless drug, we will sell 0 doses, but conditioning on a successful clinical trial, we predict the market to be $7 billion, 700 million sales of $10 medicine. Variable costs are assumed to be 3/7 of revenue, which comes out to around $3,000 on $7,000 of revenue. We have $1.8 billion in fixed costs each year. That's on top of the $1.6 billion of investment initially. And then we're going to add an assumption of straight line depreciation, right? So we put $1.6 billion in, so we have $400 million of depreciation each year. And we'll assume a 34% tax rate and kind of go from there. So this is the successful test assumption. Here, let's make this a little bit smaller so we can, there we go, now we're fitting on the screen. So this is standard NPV calculation. So here's our in year 2 through 5, we have a pro forma income statement. We have revenues minus variable costs minus fixed costs minus depreciation, and that gets us to EBIT. Then we take taxes out, and that gets us to net income. And then we're going to add back depreciation and get operating cash flow. In this case, we don't have working capital or salvage like some of the questions we did for last week. So we can keep things simple and just treat it like a 4-year annuity of $15.88. And the reason we're doing this is we need to make sure that the drug is worth pursuing if it turns out that it works. Right? Potentially, we could have a drug that works, but is too expensive to produce profitably. And so here we have a $15.88 operating cash flow. We have a 10% discount rate, and we'll earn it 4 times. So following standard time value of money practice, we just take the discounted value of those 4 cash flows, subtract off the $1.6 billion, and you get $3.433 billion. So a significant value add. Again, remember, assuming the drug passes clinical trial. So we still don't know if it's worth investing the $1 billion in the test, but this is a good sign that there's enough money. It looks like there might be enough money if things turn out well to justify spending to run the test. Obviously, something we want to check is whether it's worth doing the project even if the clinical trial is unsuccessful. So, and this wouldn't be unsuccessful like banned, but unsuccessful and then maybe not as effective as we hoped, and sales will not be as aggressive since the demand will be smaller because it doesn't work as well. So this assumes a smaller demand, right? Smaller quantity demanded, but fixed costs and depreciation remain the same, and you end up with a negative NPV. And so in the universe of an unsuccessful test, we're going to assume that we would not pursue production and sale of the drug. But that means we can choose whether or not to do the test. So the question would be, do we have, right, is our $3.4 billion of revenue enough to justify $1 billion expenditure now? And it's important to recognize that that $3.4 billion of NPV is coming at the end of year 1. So we have to take that back a year. This is, we just have a very simple probability weighted expectation here. This is kind of an extra little wrinkle in this one. We're not doing probability weighted expectations in our normal homework questions, but this is the kind of thing you do face if you're trying to come up with reasonable estimates for value for projects. And so we have our 60% chance of actually making this money, giving us a 2060, a $2 billion NPV after probability of failure is taken into account, and time value of money, putting it back 1 year additionally and taking off the $1 billion to run the test, we get $870 million. And so basically what we're saying is, the question is, should I spend $1 billion for a decent chance at $3.4 billion a year later? And the answer is yes. Maybe not as soundly yes as you might think, but the answer is yes. So that's our baseline product. So we have an NPV of the project of $3.4 billion with an overall NPV of 870-ish after we take all this probability stuff into account. Now, going forward, we're not going to really mess with this probability part. We're going to focus on this $3.4 billion number and think about what are the different scenarios that affect that $3.4 billion and go from there. So the first kind of analysis we'll do is sensitivity analysis. And sensitivity analysis asks, for a 1 unit change in some quantity, it could be variable cost, it could be fixed cost, it could be revenue. For a 1 unit change, what is the change in NPV? So revenue here, right? Revenue, if we change revenue by $1, we can recalculate NPV and get a new NPV number, and then we take the change in NPV and divide by the change in revenue and get the revenue sensitivity. So let's just work through this exact example in Excel. So I have this is the data from the problem, and we'll just repeat that NPV analysis. So I have so this is my revenue here, 7,000. Variable costs are 3/7 of 7,000. Right, so we have 3,000 in variable costs. Fixed costs are 1,800. I should put a $sign, I suppose, and I guess a comma. Depreciation is 400. And so our EBIT is this minus this minus this minus this. So there's our EBIT. These are obviously the same numbers here. We're just showing where it comes from, right? This is 3/7 of this. This is a given information and this is 1/4 of the initial because we're in a 4-year project with straight line depreciation. This is just the subtotal. So tax is going to be 34% of this number. Right, 30.34 times that number. And so we can get a net income or net profit of EBIT minus tax, 1188. And so then the final operating cash flow, adding back the non-cash charges, of 1588. And this is what we get 4 times. So if I use the annuity formula, I do this divided by 0.1. Minus this divided by 0.1 divided by 1.1 to the 4. And then subtract off that 1,600, and we get our 3434 number. Okay, so there's our baseline NPV calculation, but we wanted to do sensitivity analysis. So what I'm going to do is I'm going to copy this. Now this is going to be messed up. You'll see why here, right? Well, it's not big enough for one. But, right, why did this turn to $15,000? It should be the same number. And you can see right away, now my costs are negative. And what's happening is I did not lock these cells in, right? I should have locked these in because this was data from the perspective of this cell. So if I move these over, then everything turns out all nice and we're fine. Okay, so this is our baseline. And then this, yeah, I think if I put the E in there, it's gonna, that's silly. We'll just make it, hey, there we go, okay. And then this is our adjusted. And we're going to 7001. Oh, dollar sign in front. Dollar sign 7001. So now we have our new NPV. So if I take new NPV minus old NPV, add some digits here, add some digits. Right? And I divide by 1, and I get that 1.19. I guess it rounds up to 1.20. Sensitivity, right? $1 change in revenue led to a $1.20 change in NPV. So why do we have a bigger NPV effect? Because fixed costs don't change. So we're getting, for the same fixed costs, we're getting slightly more revenue. And so variable costs go up. See, we are adding variable costs, but so variable costs go up, but fixed costs do not. And so in dollars per for fixed costs, we do a little better. And so our NPV scales up. It's slightly better than 1-for-1, but yeah, not by much. I mean, these are pretty close. So that is sensitivity analysis. We could also think about changing variable costs. So here, let's change variable cost by 1%. So we'll take this. That's our 3/7, and I'm just going to add 1%, 0.01. Go ahead and just add a 0.01% variable cost. And let's see here, what do we get? Double click, make it big, right? $145,000 loss. So 1%, or let's see, or is that, we have to be careful. These are billions, right? So that's 145 million. Yeah, so 1% increase in variable costs cost us $145 million. So we are very sensitive to changes in variable costs. And that's true of basically all business ventures ever. And that's why you hear about advertising for cost cutting or efficiency, that kind of thing, right? It's very easy to increase the profitability of your business by decreasing your variable costs. And so businesses invest a lot of time and energy in thinking about making that variable cost lower. And also with fixed costs, but more so with variable costs, because changes in variable costs scale with sales. So if you get twice as big, you're twice as profitable. And then if we manage to lower variable costs, then it just grows exponentially. So you'll see really large sensitivity numbers for variable costs and small sensitivity numbers for things like revenue. So next up is you try it. So there's a question on the course Blackboard page that is labeled sensitivity analysis, and you can go ahead and give it a try. So see if you can figure out the sensitivity that it asks for. Again, right, it's a standard NPV, and then you just do it twice and tweak an input and see what you get. So hopefully it works, and when we come back, we'll work on scenario analysis.